Alright, let's start with topic number 3, the monetary system, the international monetary system. You'll be learning this in this topic. Alright, exchange rate system, international monetary system, and European monetary system, and monetary union. There are 5 types of exchange rate system in monetary system: free float, managed float, target zone arrangement, fixed rate system, and hybrid system. Let's see what free float system is. Free float system is exchange rates that are determined by currency supply and demand with no government intervention. In last topic, you learn unstabilized intervention and stabilized intervention. In unstabilized intervention, the government will intervene in the forex market by buying or selling foreign currencies to influence the value of their own currencies. In stabilized intervention, the government will intervene in the forex market and simultaneously engage in open market operations or the sales or purchase of domestic treasury bills. Now, in free float system, there's no government intervention at all. As you can understand, when economic parameters change, market participants would have to adjust their current and expected future currency needs. Now, what economic parameters are? They are interest rates, inflation rate, and political and economic risks. When these parameters change, you as a market participant would have to adjust your current and expected future currency needs. When there is an adjustment made on the currency needs, then it will then shape currency supply and demand, as you can see in topic 2. What is the advantage of using free float system? When government is setting new policies, government would not need to worry about the impact of these policies on the value of its currency. Why? Because the market itself would determine the supply and demand of its currency. Alright, so government need not to worry about the value of its currency anymore. Now, what about its disadvantage? Now, if a country is implementing free float system, then this would cause MMC to expose to higher exchange rate risk. Why? Because under free float system, then exchange rate will tend to fluctuate more. So it will cause higher exchange rate risk to MMC. Let's look at what managed float is. Now, managed float is also called a steady float. In this managed float, government will intervene actively in the forex to reduce economic volatility. For example, if currency appreciates too much, then this will hurt export of the country. So the central bank would have to intervene in the forex market. So this system, we call it as managed float. There are 3 types of interventions. First, smoothing out daily fluctuation. In this intervention, central bank will occasionally enter the market to buy or sell currency to smooth exchange rate adjustment. Second, leaning against the wind. This is an intermediate policy designed to moderate or prevent short or medium-term fluctuations. These fluctuations are caused by random events, whose effects are expected to be only temporary. Third intervention, unofficial packing. In this intervention, a country packs the value of its currency to a foreign currency to protect the value of its export. For example, Malaysia implemented unofficial packing when during the period of Asian financial crisis in 1997. I'm now showing you the financial crisis 1997 that happened in Asia.
Word of the day, where we break down a financial term or concept for our very smart viewer, but perhaps not the financial expert. And given that our discussion with Ann Lee centers around the United States and China, and their disputes between the two countries so often center around the issue of currency, we want to break down currency peg today, and let's take a look at how it is being talked about in the news right now. So in this article about China's currency, the yuan, being up late on a stronger central bank guidance that was received and a weaker dollar abroad, the Wall Street Journal writes the yuan is up 4% against the dollar this year and 7.7% since June of 2010, when China ended its currency peg to the dollar and vowed to make the yuan more flexible. So there you see it, but what exactly is a currency peg? Well, it is a country's or government's exchange rate policy of pegging the central bank's exchange to another country's currency. So you may ask, what is the point of doing it? Well, here's the reasons why. If you peg a currency artificially high, it means you're a country that's trying to encourage foreign money to come into your economy. You're trying to attract capital. And if you peg your currency artificially low, it means that you're trying to encourage exports. You want your country, your industries to export more. Now, when a country pegs its currency artificially low, as is argued in the case of China currently, which still loosely pegs its currency to the dollar, the central bank has had to intervene in the market, and it does this by buying up foreign currency and adding to its foreign currency reserves. As you can see, China's share of the world's foreign currency exchange reserves have certainly risen. Now, this also creates inflation domestically. And what happens when a country pegs its currency artificially high? Well, this happened in the case of Argentina. For example, prior to 2002, I'll go back to this chart, but basically the central bank has to intervene in the market by buying up its own currency with foreign exchange reserves. Now, let's look at how this can play out, and I want to continue to use this Argentina example. So, Argentina originally pegged its currency, its peso, to the dollar in 1991. You can see this here. It's this flat line, but it eventually came unglued at the start of 2002 as people started dumping their pesos. Argentina, I think you probably know, is going through a tough time, going through a depression. The peso came under increasing pressure, and the government eventually had to stop intervening, allowing the dollar, you can see what it did, to appreciate very rapidly against the peso. This is the dollar's value shooting up relative to the peso. So this is how you can see the impact of what happens when a currency peg, isn't able to be maintained. So this has everything to do with trying to affect a country's exports and investments in relationship to other economies, which is why this becomes an international issue, much more complicated than I can explain in word of the day, but now you at least know basically what a currency peg is.
Alright, let's read through this article. Malaysia experienced financial crisis in 1997. Malaysia experienced financial crisis in 1997. Prime Minister of Malaysia for the period of financial crisis claimed that George Soros should be partly responsible for the financial crisis in 1997. However, after 9 years, George Soros visited Malaysia for the first time, and he met with the Prime Minister for the first time. And the Prime Minister considered that he did not view George Soros as responsible for the financial crisis. From the picture, you can see that they were friends, and in fact they shook hands. Malaysia implemented currency pegging during the financial crisis. Let's see what happened to the financial crisis in 1997. Let's watch the movie on Asian financial crisis 1997.
Thailand received an emergency rescue loan from the International Monetary Fund. When that didn't work, the Thai government asked Washington for even more help. No one imagined that an economy as small as Thailand's could spark a global crisis.
Thailand is a very small economy. It doesn't have a lot of links, and it's not exactly in your backyard. In any event, the U.S. chose not to intervene in Thailand, thinking it was not going to spill over. Why would it? The contagion effects were not apparent to anybody, not just the administration.
I think they misjudged the situation. Probably because it was seen too much as a financial issue rather than an overall strategic issue.
Global markets worried that other Asian countries might have similar hidden flaws. Like a classic run on the bank, money began to pull out of the entire region. They called it contagion.
And at each stage, the crisis turned out to have a virulence which became known as contagion, much greater than had been anticipated. And what that really reflected was indeed globalization, was the way these economies had become locked together, and investors looked at emerging markets. They said there's a problem in Thailand, well then there's a problem in these other countries. And so each step of the crisis created these shockwaves that carried on into the next.
Contagion spread to Thailand's neighbors. Malaysia's economy had seemed stable. Suddenly, it too was facing relentless pressure from global markets.
We have the currency going down and down and down. We have the stock market doing the same. And we felt totally helpless. We feel that there is no way we can recover. So, the feeling is really very bad, very frightening.
Contagion next hit Indonesia, the most populous country in the region. Its government collapsed. Its cities descended into chaos.
The fund managers didn't know the difference between Indonesia, Malaysia, Thailand, Singapore. They just said, I want out. Property prices collapse, companies collapse. And in the case of Indonesia, the social fabric collapsed. Churches have been burned. Mosques have been attacked. They have killed each other. That is all the fallout of an economic collapse.
This was a new kind of financial crisis, unlike anything the International Monetary Fund had ever encountered. The IMF organized huge loans for Indonesia and other Asian nations, on the condition they cut government spending, raise interest rates, and eliminate corruption.
You are the doctor going in to deal with a very sick patient. The public blames the doctor for the fact that the patient is sick, but the patient was sick to begin with. But these things are societally wrenching. There are huge vested interests. And you wouldn't get into these crises if the vested interests weren't that important. That, I think, is one of the reasons why it takes political change to deal with a crisis as big as this.
To some of the region's entrenched leaders, the IMF's conditions smacked of a new kind of colonialism.
Presently, we see a well-planned effort to undermine the economies of all the ASEAN countries by destabilizing their currencies.
In the old days, you need to conquer a country with military force, and then you can control that country. Today, it is not necessary at all. You can destabilize a country, make it poor, and then make it request for help. And for the help that is given, you gain control over the policies of the country. And when you gain control over the policies of a country, effectively you have colonized that country.
The market forces were simply too powerful for the IMF or any government to contain. In late 1997, contagion reached Korea, one of the most successful economies in the world.
It was unbelievable that the crisis has spread as quickly as to Indonesia and Korea within the matter of 6 months or 7 months. But the world was much more globalized than we thought it was at that time.
In the last week of December 1997, the 11th largest economy in the world, which is Korea, had, roughly speaking, 4 billion of reserves left, and was using reserves at the rate of $1 billion a day. It didn't take a great deal of quantitative insight to see that that was not a long-term viable situation. Korea had been misleading the world, claiming it had enough money to withstand the crisis. The IMF's Stanley Fischer arrived in Seoul to inspect the central bank's accounts.
I visited Korea a couple of days before they turned to the IMF for help, and there was a state of panic. And it was at that point that I went to the central bank and was shown how much money was left in the Korean central bank. It was essentially all gone.
Korea was about to default on its loans from Japanese and Western banks. Pressured by their governments, the banks agreed to share some of the pain. They rolled over their loans. Korea was then given the largest bailout in history.
If they had done that in Thailand, I think that they would have not only avoided some economic problems, but I think that the sense in Southeast Asia that the Americans were really on the side of putting things right would have been stronger.
Then a very, very strange thing happened. From about the 1st of February 1998 until August, there was a period in which financial markets essentially decided that risk didn't exist anywhere.
Markets thought contagion had been contained in Asia. Investment flowed elsewhere. Some came to Russia, where the Moscow stock market was the best performing in the world. But economic reforms had stalled, and Russia was heavily in debt. Even so, investors were convinced they'd found an emerging market that couldn't fail.
Investors had decided Russia is an ex-superpower. It has lots of missiles and lots of atomic warheads for them. Certainly you could not have a financial accident in Russia because the rest of the world, the rich countries, would bail Russia out. Well, it turned out that that was wrong.
Russia defaulted on its debt. Its currency plummeted. Global investors were stunned.
All these people who in the previous 7 months had decided there was no risk anywhere literally panicked and decided there's got to be massive risk everywhere. Behind each fence and barnyard wall, there must be a risk that we hadn't thought of, kind of like the redcoats retreating from Lexington.
Everywhere, markets were freezing up. The economic crisis seemed to have taken on a life of its own.
I thought at the time that I had a pretty good sense of what was going on. But what I didn't know, and nobody could possibly have known, was not what was going on at the moment that you were looking at, but what was going to happen at the next moment.
Oh, when you get in a room with both Alan Greenspan and Robert Rubin, and they say they're scared to death, and they've never seen anything like this, and they're worried about whether or not we can get through it. I get worried because I know a heck of a lot more about it than I do. You had the contagion sweeping across all the developing countries. As Rubin said, we've never seen that before. I mean, Maybe in the Depression they saw that over a period of time, but nothing that happened that quickly.
Now the crisis had reached America. A little-known but powerful private investment fund was on the brink of bankruptcy. Long-Term Capital Management, or LTCM, directly controlled $100 billion of global assets and indirectly more than $1 trillion.
The 90s saw a huge buildup in concentrations that we had never seen on a global scale. Maybe we had way back in history. Maybe the Romans had financial institutions that were disproportionately large to the overall activity of the world that they operated in. But LTCM was a specific type of hedge fund. They were involved, whether it was the Singapore Exchange, the Tokyo Stock Exchange, the London Stock Exchange, the New York, whatever. There was no market that they weren't maybe the largest player or close to the largest player.
By September 1998, LTCM's losses were spiraling out of control. Contagion had arrived on Wall Street. Incredibly, the failure of this single investment fund threatened the entire global economy.
If LTCM went down, it would be just the gears, the machine just stopping, the economy not working. And of course, it's not just what's on the balance sheet of banks and so forth, but that would translate into people not working, businesses not operating, small businesses not being able to get the capital they need, and this a global economy that's almost inconceivable to see with the picture, but sort of just not working, and people just not working.
The New York Federal Reserve summoned representatives of major U.S. and European banks to an urgent meeting. John Corzine, then at Goldman Sachs, was among them.
The real problem with long-term capital was nobody really understood all the downsides. All one knew was it was going to be extraordinarily dangerous to enter into that. And everybody, I think, understood the Fed's concern that that had real implications to the real economy.
Since LTCM was a private fund, the government could not impose a solution. The fate of the global economy was in the hands of these bankers.
The head of a securities firm or a bank is not paid to be a patriot. He or she is paid to serve the best interests of the shareholders. So the most that one can do in a position like mine is to say the public interest may well be served by long-term capital management not failing. But there is no public sector money to solve the problem. The taxpayer is not going to do this. You folks have to decide whether it's in your interest to do it.
The banks agreed to put up their own money to rescue LTCM. Wall Street had averted disaster, but the global crisis had one final chapter to go. What had started in Asia now reached Brazil, the 8th largest economy in the world.
Alright, it is ended now. Let's proceed to the lecture.